everyone. Today I want to talk to you about fixed and variable interest rates. We are currently having a lot of people ask us whether they should fix their loans or not. And in the nearly 2 decades that we've been operating, we've done a lot of research throughout that period to determine whether a fixed or a variable rate is better. And for all the research and all the comparisons that we've done, we have never found an occasion where a fixed rate outperforms a variable rate. So if you were to take a fixed loan and compare it to a variable loan over a period of, say, 5 years, you will find that you will always pay less on the variable loan than you will on the fixed loan. And I guess, it's not hard to work out. Banks aren't in the business of losing money. So you will always find that you'll get a better performance out of a variable loan than out of a fixed loan. So it's not really a financial decision when it comes to choosing whether you should fix your loan or not. It's really an emotional decision. And if you are looking for, certainty, if your budget's tight, if you want to be sure on what your interest payments are going to be over the next 2 or 4 years, 5 years, or for however long you fix your loan, then there are, there's some advantages, some emotional advantages to having that comfort to know that those loans are going to be fixed at a certain payment every single month. There are some disadvantages to fixed loans. Of course, you can't make extra repayments into them. There are penalties for that. You can't have offsets. So it's quite a set and a very stringent product. So, but if you're after flexibility, then variable is definitely the way to go. So if you're somebody that gets bonuses, you expect a salary increase, get an inheritance, that's where you can then take that money, you can pay it off the principal, you can reduce your debt, or you can have it sitting in an offset, which will reduce the amount of interest that you pay anyway. So variable loan gives you a lot more flexibility. But if you're after, both, then you can get some more certainty as well as the flexibility around by having a split loan. And that basically means that a portion of your loan is set and it is fixed with a certain mortgage repayment coming out every month, and then you have a portion that is variable, so you can get the flexibility that the variable offers. So that's the economics of the two types of loans. But where we currently sit now is that in last year we saw the 2-year fixed rate. You could get a 2-year fixed rate at around 2% last year. The year before that, you could get a 4-year loan fixed for 2%. And we've slowly been seeing that banks have been factoring in an increase in interest rates into their fixed rates. So, you're not very likely to get anything under a 3% now. So banks have already factored in the increases in interest rates that are being anticipated at the end of this year. So that means basically if you're fixing a loan now in 2022, you are really going to be paying a premium rate for that fixed loan. So you need to think very carefully about whether fixing your loan is the right thing for you and your circumstances. So I recommend that anybody that is thinking about doing that, speak to your mortgage broker and get them to run through the scenarios and figure out which best suits you and your financial circumstance.